As we make our way into the second half of the year and are quickly approaching the July Fed policy meeting, there are a lot of questions as to how the Fed's policy course might influence rates and fixed income markets. What can we expect from the Fed, and how should fixed income investors be positioning? A conversation well worth your 10 minutes right here on UBS Trending. Hi everyone, and welcome to UBS Trending. I'm your guest host, Dan Cassidy. Leslie Falconio is back here in the studio to break down the latest fixed income strategist publication. So let's get right down into it. Leslie, welcome back. It's great to be with you as always, and looking forward to our conversation. So let's get right into it. As we're speaking here today, Leslie, it's hard to believe we are in July, so well into the second half of 2023. Can you speak a bit from your lens what the landscape looks like for fixed income investors through the balance of the year? Any tailwinds coming with us from the first half? Any headwinds ahead of us?
You know, that's a great question, Dan. And I think here's somewhat where the, I want to say issue, but some of the concerns that we have in the second half, right? We know the first half of the year, let's start with that, the terminal rate has been shifted higher about 3 or 4 times because obviously most market participants came into the year thinking that the economy would slow, the Fed would pause, and even many strategists had several interest rate easing in the second half of 2023. And as we've seen, the consumer's been much more resilient, corporate profits have been much more resilient. So now that we sit here after the guidance of the Fed, and finally the market has adjusted to the higher for longer strategy of the Fed, they're still not quite pricing in the guidance that the Fed is giving the marketplace. And what I mean by that is that when we look at the economic projections from the recent FOMC meeting, they have 2 25 basis point rate hikes in, so a total of 50.
Sure.
The market right now is saying, okay, you're only going to do 25, right? So that's kind of a bit on the negative side to the market. On the positive side, they've taken out all those easings that we saw in the second half of the year. So as you as a fixed income investor, and you think about the level of interest rates, right, which as we know, yields go up, price go down.
Sure.
So you think about that in terms of your total return. When we sit here today, given the fact they're pricing out those easings, actually have put us in a better position. However, they're still not quite hawkish enough. So really this is going to be more of a wait and see type of scenario. And when it comes to the vulnerability of the marketplace, and particularly when it comes to fixed income, is going to be if there's a reacceleration of inflation, right? We know that inflation has been trending downward, nowhere near the Fed's target, but at least we've had this downward trend. Now, if in fact that should shift in the second half of the year and start to reaccelerate, at that point in time, you're going to go back to that 6% terminal rate the Fed was sort of guiding in the first week of March. That'll push interest rates higher. But when we think about it as a fixed income investor, we just don't believe that that push higher is going to be sustainable. And fortunately for investors, plus particularly in today's market, fixed income is doing what it's supposed to do and earning you income and a lot of yield. So that's serving as a great cushion.
Which it has really throughout the course of 2023 thus far.
Absolutely.
So I want to run with the Fed a bit further from the standpoint of an investor. It sounds like a bit of a balancing act as you gauge what the course ahead looks like for monetary policy, starting with the July meeting, which is just a couple of weeks away at that point. Can you dive a bit deeper into CIO's expectations for this upcoming meeting? And then maybe we could talk a bit about expectations through the balance of 2023.
I think, listen, more than we're going to have CPI, we'll have the payroll report before the July FOMC meeting, but we would put a high probability that they move 25. They've kind of addressed it. They've left the door open for that. The market wouldn't be shocked if they did. So more than likely, they will do that 25. I mean, one of the things that's going to be a focus is the fact that when the CPI comes out mid-month, that year-over-year change that we're going to see from June of 2022, when we saw that really big spike in CPI, is going to roll off. And remember, in June 2022, you had $5 at the gas tank.
Well, the difference
you had 120
right?
in oil, right?
Right?
So it was a much different thing. So that's going to roll off. So the number as a whole, the headline will come down.
Right.
Now, everyone knows this. The Fed knows this, right? So I don't think it's going to be something that's going to fool the market saying, well, we're going to be on this really, this inflation is going to guarantee to come down going forward. I do think the Fed will probably lean more on the cautious side and move unless there is a really big surprise. Going forward from there, it's really going to be difficult in terms of predicting because it really is, and I know we've said this so many times, but it really does depend on the data. I mean, more than likely, they are very near the pause, but more importantly, they won't ease. So there's a difference between a pause and a pivot. So they're going to pause, they'll keep higher for longer, and over time, those higher borrowing rates, those higher costs to the consumer will continuously be a headwind to the economy, and therefore the economy will slow, and more than likely you'll see that easing path in 2024.
So too soon to talk about rate cuts, or is that for another conversation?
I think it's too soon unless there is some sort of catalyst, and you never say never,
Exactly.
particularly in markets like
As
this.
the first half is
That's
demonstrated.
Right. That's right. I mean, listen, if there's something where the market is really shocked and sees, negative payroll reports for, 3 consecutive months, that's a different story.
Right.
Or if there is something something geopolitical event that occurs, as we can see, is still, alive and well.
Absolutely.
That could really adjust the Fed's pause to pivot time frame. But more than likely, if the data trends the way it is now, below trend growth, but not recessionary, then more than likely those easing won't come in until 2024.
All right, so we'll get through July 1st and then see what the balance of the year has in store. So from the vantage point of an investor, Leslie, when it comes to positioning, allocating within the asset class, what are your recommendations? What's really going to drive yield through year end?
The yield component is an incredibly important component to the total rate of return of fixed income. I mean, for example, we've had a lot of volatility this year, but when we look at, December 31, 22 to where we are today, there hasn't been a lot of movement, right? IG spreads are 2 basis points different. Most high quality spreads are like 2 to 3 basis points different than what we saw from the beginning of the year. Interest rates might be, 10, 15 basis points lower in the 10-year, not material. But the interest rate volatility has been very, very high. Right. So you've had a lot of intraday vol to net, really not have that much movement, right? But I do think that the yield component really is going to be the driver going forward. And even though we could say to ourselves, when we look at things such as investment-grade corporate spreads, there's nothing there that's flagging this is at a historical cheap point, because they're not. However, when you look at what you're earning in terms of 5.88% in yield, things that you could have for higher quality, plus that embedded interest rate risk, if in fact the equity market slows, the economy slows more than we're expecting, and we do expect the 10-year yield to trend lower by the end of the year and into 2024, that is really a great tailwind to total return. So we still like those higher quality sectors. The yield curve is inverted, and it's been inverted for over a year, that 2s 10s, which is now, say, around a negative 100 basis points. It's a very long time to be inverted. Because we don't think the Fed will ease until 2024, it's going to stay inverted for a while. And it's really important to respect that kind of inversion of the curve in terms of how you play your positioning. And what I mean by that, Dan, is that we have this barbell position on because we like that carry in the short end, right? But we also want to lock in right now, too, around that 7 to 10 year because you're earning these yields. And we have that in the investment-grade corporates. Mortgage-backed securities is one of the cheapest sectors out there. They face some headwinds because of unexpected supply from what we saw during that financial instability. And also, too, we like preferreds. Now, preferreds is a higher quality sector. It's investment grade, but it does have a little bit of that, kind of equity component to it. So it's going to be a little bit more volatile. It does have a little bit more credit risk, but you're earning a lot of carry, and we do think that's a sector that has the potential of price appreciation.
So a lot of considerations out there, a lot of reasons to stay invested from the vantage point of a fixed income investor. So Leslie, thank you very much for dropping by, providing that setup for the second half of 2023, including some expectations for this key upcoming Fed meeting, and of course your guidance when it comes to asset allocation. As always, great catching up with you, Leslie, and thank you for your time today.
Thanks very much. I appreciate it.
Absolutely. For more information, visit ubs.com/views. Make sure to follow UBS on social media, LinkedIn, Facebook, Instagram, Twitter, and check out our Instagram channel at UBS Trending for UBS Studios content that you can't find anywhere else. And as always, if you have any questions about your portfolio, please speak with a UBS financial advisor. Until next time, I'm Dan Cassidy, filling in for Anthony Pastore. Have a great rest of your day, and remember to keep your eyes on what's trending.